I'm Michael Fox, and this is the Prospector News Podcast. And have joining me, as we always do after the Fed meeting, Chris Temple of the National Investor, and we're gonna talk about the Fed again. Welcome, Chris.
Well, and a lot to talk about this time around, that's for sure.
Yeah, I thought, it was, the lazy days of summer. It was going to be quiet, it was going to be a whole hum. We're going to do nothing and say nothing. Up until the last couple of days, actually, I was in the camp that we wouldn't see any interest rate changes until after your election. But 72 hours later, here we are.
Well, I'll tell you what, the markets have made one of the most abrupt changes of any time I can remember in 40 plus years. Of up until recently, you've had at or near all-time highs still for the major stock indices. You had the idea that the stock market was doing so well, although as you and I have talked previously, it was masking some deterioration in the economy on Main Street for a while now. But you had that, therefore you think, okay, the Fed's going to finally start to lower interest rates by the end of the year. They haven't had to do it now because the economy has stayed so strong, blah, blah, blah. And now, like someone flipped a switch, everyone is in a minor panic. The Fed waited too long. Now they're paying attention to some of those economic statistics, some of which were there before, some of which are now worsening, particularly the employment numbers in the last 2 days, as we're recording this on Friday. So now everybody is out there saying, well, the Fed waited too long. They're going to have to be more aggressive. Chairman Powell on Wednesday afternoon did pretty much set the table, as I said last weekend he would, for at least a 25 basis point rate cut come September. That has became, as of Wednesday afternoon, anyway, when he was done, the base case, there would have to be something special to convince the Fed not to move in September. But now, after weaker economic stats and the employment numbers and so forth, the drop in year over year wages, et cetera, now, as of this morning on Friday, following that news, there's about a 3 out of 4 chance that the Fed, according to the Fed funds futures markets, goes 50 basis points, not just 25, come September, because now all of a sudden it's believed, though nobody believed this 48 hours ago, that the Fed did wait too long. And look, not that that should be a surprise. They always do things too much or too late. So they waited way too long to rein in the inflation that they caused. That they raised interest rates a lot. They waited now to go back the other direction. Even though Powell on Wednesday, Mike, if you saw this, did kind of confess that, okay, well, we're seeing some of the lag effects of all of these rate hikes, and maybe we won't wait until we see the whites of a recession's eyes. Well, the market thinks they just saw the whites of a recession's eyes in the last couple of days, and now they're in a full-blown panic or nearing that. They're going to be pining for the Fed to start cutting rates more aggressively, half a point at a time come September. If not, do it even before the September meeting. But, that would probably make things worse because it would show the Fed is going to panic. And I don't think they're quite there yet. Although it's not going to shock me if in the next couple or 3 weeks we start to see some of the messaging from the FOMC, Federal Open Mouth Committee, with all of these competing Fed poobahs out there. They'll start to muse about the possibility of a 50 basis point cut in September. And that for a while might help shore up the markets from this debacle of the last couple of days.
Yeah, it's really quite interesting, as an observer, and you and I have talked about this in past podcasts. Every time there seemed to be negative news, the markets took that as positive that the Fed was going to cut rates sooner than later, and the party would be back on. And as you and I spoke about it constantly, it was just like, careful what you wish for. When they turn around to cut, it means that the wheels are starting to fall off.
That's right. And again, as I said a minute ago, too, the Fed always waits too late. All of this pining and expectations of a soft landing, you have to go back a lot of years, and the Fed has hardly ever hit one of them yet, to any accurate extent anyway. So this is no shock, But again, I think that you've got this washout now. The VIX spiked the most today as anybody has seen in a long time. The VIX was up 50% in one day earlier. Now it's up 42 as I just took a peek at it as we're talking. So we'll see what happens. I don't necessarily think that this waterfall decline that we've had all of a sudden is going to continue, though over time I think we will continue to see it. And this will probably, when we look back, say, damn, the bear market finally started in the summer. Um, but for the near term anyway, stocks are getting oversold, and especially if a few of the talking heads come out sooner rather than later and tease the markets with the idea that we got the message, we see that the bond market is front running a recession now, not rate cuts. And we're cognizant of that and realize that maybe we need to move a little bit quicker to catch up now on this side. That might short things up a little bit. And keep in mind, too, there's still lots of liquidity in the markets. There has been for some months now because of the higher interest rates, uh, record after record being set as far as money market fund balances. So, we're not going to see this all turn into a debacle right away, a big one that's not going to have a bottom. But this definitely, and I think in the end it's going to be healthy, does start to change this Pollyanna-ish attitude that the markets have had for so long, that everything is a reason to buy. And as you pointed out very accurately, now you start to look at these worsening economic statistics and say, holy cow, the Fed's not going to pull off the soft landing after all. Let's get that into our heads and then figure out what that means, that what we can do proactively with our portfolios.
Yeah, it was interesting on Wednesday before the Fed made its announcement. I had Mike McGlone from Bloomberg Intelligence on a podcast, and we were discussing what was going to happen with the commodities markets going forward. And we were almost near the end of it when the Fed announcement came out. But the thing that I took away from our discussion was that for the last couple of months, the commodities markets have been really signaling quite loudly with like waving semaphore flags and flashing lights that, a recession was near. Precious metals were going up because of, their insurance, and the industrial metals were going down because, demand was going to be curtailed. And then as I say, the Fed announcement happened, and 72 hours, here we are.
Well, for a while now, Mike and I have used one another as foils. I remember a year ago, this last winter, so a year and a half or so ago, and inflation was still a fair bit higher. We were all at Mines and Money down in Miami, and I asked a rhetorical question during one of my talks: who in here believes the Fed can really pull off this move back to a 2% sustainable inflation rate? The only room in the hand that went up was his. And he's referred to that. I referred to that. And Mike's a smart guy. He's not a perma bear by any means. He's analyzing the data as he sees it. And look, he's going to have the better of the argument in the near term. I did another podcast yesterday. Our mutual friend Shad Markwitz at the Correlin Economics report, and I said, hey, for the near term, it doesn't matter how good the individual fundamentals are, crude oil stocks, base metals, almost across the board. Some of them are going to go from bad to worse. And it doesn't mean that the fundamentals are worse. It means that all of the markets now that they've had this epiphany that we really are going to go into recession, they sell commodities first and ask questions later. That's what the textbooks say to do. That's what their algorithms tell them to do, et cetera. So that's just going to be the near-term fate of things. Where I still differ a little from Mike is I think, still believes that we're going to go into a long period of disinflation, if not deflation. And I think there's a host of supply reasons why, if we did see something like that, it's going to be very brief. Uh, all of these different commodities are in short supply. This is not like past moves where you're going into a recession with healthy levels of commodities. There's very unhealthy levels of a lot of them. But as you know, as copper has done recently, it went from a blow off top after hitting a new all-time high not that long ago of well over $5 a pound. Now we're going to be dropping under three and probably going to stay there for a little while. Long term, that is not anywhere as remotely near the price needed to bring copper to a market that is starving for it and is going to be in very serious trouble going forward without being able to get the supplies that we need for all manner of things the world over. And those are needs that are going to be there whether we're in a recession or not, maybe a little bit less so. But that, you know, even when you look at oil, Mike, and think about this, and Mike,
Yeah.
when you look at a long-term chart of crude oil demand, every single year it goes up with scant exception, even during recessions. The only time you saw it go down and energy demand overall go down was right at the beginning of that COVID pandemic, and everything was shutting down for a while. And even there, when you look at that very short-lived decline in actual demand for energy, you got to look at it with a magnifying glass because you miss it almost in the overall uptrend for demand. And that, look, that's not going to go away unless you really think we're going to have a massive depression, go into a stone age, the banks all collapse. Well, then okay, then we're going to have deflation at least for a while until the Fed and the policymakers react to that, trot out more stimulus programs and quantitative easing and add a zero or two to the end of them.
Yeah. And the other thing that Mike likes to do, and it's an interesting way to look at it. There's we always refer to as Dr. Copper, who's got a PhD in economics because he can signal good times and bad times. Mike likes to look at these other two variables, which are really interesting, which is the diesel gasoline market and the corrugated cardboard market, because that's the shipping of the goods that go to the stores, go from Amazon to your front desk and your front doorstep. And um, for the last year and a half of talking with Mike and doing these podcasts, he's been pointing out that both of those markets have been trending downward and quite consistently.
Oh, great points. And we've talked about that as well. I don't quibble with that at all. And look, I think what you need to do going forward, all of us, is figure out, and it's based on, you know, sometimes I boil it down and say, you know, buy needs and sell wants. I was just having a conversation, just getting up here in Wisconsin and seeing what little bit I've been able to see of the local area so far, and a few of the anecdotes I shared with you separately on my way here. I believe for a while now that the consumer economy has been slowing much more than anybody wants to admit. And I'm not seeing the activity and the energy. You know, I'm seeing a lot of empty streets when I come out into traffic when I were at places I shouldn't see them. So, all right, I get all of that. But that doesn't mean prices can fall across the board. The conversation I had with my son and son-in-law the other night, one of them's talking about, you know, trying to find a bigger used boat for the family because the kids are all bigger. I said, you know, the prices are only going to go down. So by that measure, by the measure of other toys that are going to become expendable if we go in, as I believe we will, and I know you guys do as well. We're going to go into a prolonged period of time of stagnation, stagflation, whatever you want to call it. Yeah, a lot of things will actually decline in price from present levels. You know, appliances, a lot of different non-durables. You know, if your dryer is several years old, you get to the end of the cycle and you got to run it 10 more minutes. Well, if that's your choice, as opposed to going out for a lot of households and buying a dryer that you can't afford, you're going to run it the extra 10 minutes or maybe 15. Maybe you're not going to use the boat as much. Put it out in the front yard, see what you can get for it. Same thing with a lot of vehicles, same thing with a lot of stuff that you don't need. But unfortunately, I still tend to believe that the stuff that we do need every day, fuel, whether for to heat our home, which is very stressed right now. All the electric markets in the US are stressed to one extent or another. Electricity rates sure as hell are going to keep going up not down, at double-digit annualized rates for a lot of reasons, as far as the eye can see. Gasoline, I think we've had somewhat of a gift that we didn't get as big a boost this summer, but U.S. oil production is rolling over. Dry gas production is starting to get shut in a little bit more. So I think we've seen all the help we're going to get from energy. Food is going to keep going up. So it's not going to be, a seamless story one way or the other. We're not going to have outright deflation. I don't think even outright disinflation, except for the stuff that we don't need, those wants that I mentioned. But stuff that we do need is going to continue to inflate. I've got a really good car insurance company, Mike. Florida Farm Bureau. I'll mention her name. They've been very good to me. A couple of accidents since I've had them that weren't my fault. They paid it, no questions asked. You get a little bit of bump up in your rate to compensate, then it goes down. In one fell swoop recently, I went from 160 a month to 230 a month. And I checked around to our other car insurance companies, similar stories, unless you want to try and save money by drastically cutting how much coverage you've got to a place where the average person wouldn't be comfortable, me included. All right. And I asked the agent, I said, well, what's so special this year about why there is such an outlier of a move higher? And he says, well, check with everybody else, but now they're finally starting to catch up with how much labor has gone up, how much replacement parts have gone up, et cetera. Those things aren't going down either. And I know everybody that else has to pay for insurance of one kind or another doesn't believe that we're going to have disinflation there either. So it's going to be a mixed bag. Unfortunately, it's going to be mixed still in such a way that, and I've been, as you know, calling it this for a while now, we are in the great stagflation. Doesn't mean that we're going to go back to 9 or 10% inflation like we had a couple summers ago, but it doesn't mean that we're also going to go down to 2% either and stay there by any reasonable measure, unless the Fed really has lost control of things and we have a full-blown major recession or something worse.
Yeah, it's interesting when you look at the inflation numbers themselves. There's main components that seem to be really driving the inflation, where a lot of the other things have cooled off and are holding it back. But insurance was one, healthcare was another. You had food inflation and you had energy inflation. That was what was driving the inflation bus. But you know, new and used car prices have diminished. Consumer goods has diminished, electronics have diminished, but these other inflationary pressures have been greater than the disinflation from those other things. So inflation remains high. And I think that's where we see the disconnect between what the Fed and the government tells us and what Main Street feels, because those are the things that Main Street need to buy. They have no choice.
That's right. And so exactly the point that I'm trying to make here is that we've got a long period of stagflation ahead of us. Keep in mind too, and you've done well to point this out in the past when we've discussed it, even if we're going to settle down to a 3% give or take year over year increase in inflation, that's on top of a much higher base. Prices have already gone up in the last few years, 20 to 25%, depending on how you want to measure them. And I still think that's generous because a lot of things have gone up much more than that for the average household. So you're adding 3%. Yeah, that sounds good, but it's to a much higher threshold of prices that we're starting with. And speaking of that, the other thing that's going to really challenge the Fed over the balance of the year is they're now probably going to feel a lot more heat in the days ahead to start off with a few rate cuts aggressively and hope that they can mitigate the damage that's already been done. The year-over-year comparisons for the next, really the balance of the year, are going to be difficult because it was the last few months of 2023, if you remember, that inflation came down at such a rate. I mean, and again, the year-over-year increases in inflation came down at such a rate that it had Powell last December already opening his mouth and saying, well, maybe we're going to, be able to cut rates sooner rather than later. The markets were looking at 6 rate cuts for the year. Now we've come full circle because as of this morning, the Fed funds futures market is looking at 125 basis points of cuts by January. So we'll see if it stays that way or gets worse. I don't know. But, on the way there, it's going to be hard because the price increases that remain for the balance of 2024 are going to be matched against that lower threshold for the end of last year. So now you might see those year over year numbers bump up again a little bit, and that's not going to make the Fed look very good either way. So look, this is a mess as always of the Fed's own making to begin with, except now both ends of it are arguably bigger and more ominous than anything they did prior, especially on the front end where, the inflation that they unleashed by printing a third of the dollars nearly that were printed the entire existence of our country have come out all, in a couple of years' time. And that's the other thing, not to ramble any more than I already have, Mike, about the state of things going into this recession because we're going into this recession with a third higher level of debt than we had before. So you've got much higher interest costs and debt servicing costs, much less credit available for markets because the government's going to take so much of it. We're well over $1 trillion a year just in interest costs now on a debt. We're adding $1 trillion about every 3.5 months, whatever it is these days. So, that's another reason why it's almost mathematically impossible, the idea that we can go and have an extended period of disinflation. The only way that you're going to manage this debt is that inflation will stay chronically high. And the only good thing that may come in 2025 to mitigate that is if whatever the mix of government and government policy we end up with after the election, if they realize that the next stimulus program, which will undoubtedly come, needs to be comprised of something productive, really supercharging our move toward the energy so-called transition, which really is an energy addition. We've got to have more energy wherever it comes from. But if we have massive permitting reform, massive acceleration in the extractive industries and all the different parts of the food chain for not just EVs, but energy across the board, our power grid, which is strained more places than not, then maybe with chronically higher inflation and interest rates, we would get some decent growth, more higher paying jobs, and have a better chance of muddling through that way.
Yeah, now you talked about government debt as being, problematic as we head into this next recession, but at the same time, consumer credit card debt is at all-time highs as well, and you're going to have a consumer that's going to be pressed down upon with with a recession, with high credit card payments, et cetera, and I think the number I saw recently was close to 10% are in 90 days default. There's
Right.
more problems, for the consumer-driven economy on Main Street going forward.
Well, there are, and that level of delinquencies right now for credit card debts is the highest it's been in about a dozen years. I think even more so for the delinquencies on a lot of these subprime auto loans, where people in the recent past, and at least it's not houses this time around. In relative terms, the housing market and that part of the consumer economy is in much better shape than it was, 15 years ago when we had the bust. Um, the commercial real estate, that's not the case, but at least for consumer real estate, it is. But, that's been replaced by the credit card delinquencies, by subprime auto delinquencies, and so forth. And it's going to bring a lot more belt tightening. So, as you mentioned, Mike McGlone pointed out, correctly so, that you look at corrugated board, you look at some of the stuff that's been out from both UPS and FedEx as far as shipments are concerned and what their revenues are. And this has been going on for months. It's only now, with a lot of this stuff hitting at once, that the markets all of a sudden have decided that they're going to pay attention to these numbers again.
You've been on the Temple family summer tour, as you do every year. We've kind of, we live in, a rural environment in Prince Edward Island. Our nearest Costco is 2 hours away in Moncton over in New Brunswick. So, we drive through a lot of areas. You left St. Augustine a couple of weeks ago. driven up to the Midwest. We've talked in the past about one of the key recession indicators on Main Street, and that's the toys in the yard. What was your observations as you went up from Florida to Illinois?
There are more perceptible signs of just a slowing of some manner in travel and consumer activity and things like that. Interestingly, according to the EIA stats, we're still pretty much near record high gasoline demand. But I don't know. I have to wonder if that's going to start to roll over and follow production levels down. That remains to be seen. But look, even before I left home, I was seeing a little bit less activity in the St. Augustine area, and St. Augustine, of course, is one of the premier vacation destinations, and not so much for snowbirds, but it's being in northern Florida, we're a half hour or so below Jacksonville. They share everybody else's season, so you expect, aside from Christmas, which is very unique for the St. Augustine area. And folks, if you've never been there, you need to come and check out the Nights of Lights, one of the top 10 Christmas displays anywhere, according to National Geographic magazine. It's breathtaking. It's just a magical place to be. But aside from that, it's, all the usual suspect holidays, Memorial Day, 4th of July, Labor Day, and so forth. And there was a notable, it was less congested than it typically is. Still was, don't get me wrong, but I think the static base of activity from the locals and people nearby, not counting the tourists, that has definitely fallen off a fair bit. And I'm seeing, as you do, anytime you have situations like this, it's interesting as a foodie and having had a few friends in the restaurant business, and still do, to see how people's habits are changing as far as what they spend and things like that. Just last year at the New Orleans conference, I grabbed Jim Uriel real quick. He's a well-known market commentator, very smart guy, and also a restaurateur in north central Illinois. And I was asking him even back then, this is last summer, what he was seeing. And he was already seeing signs that the average size of a check was a bit less. Maybe you're not going to have that final drink before you go out the door. You don't order, one of the more expensive things on the menu. So again, this has been brewing for months. The Main Street economy has not been reflected by these record highs we had in the stock indices until recently. And yesterday, I was listening to some of the comments. I'm sorry, not yesterday, Wednesday afternoon after the Fed meeting, while I was driving from below the Twin Cities back up here to Northwest Wisconsin, bounced around among my children and grandchildren. They had Jeffrey Gundlach from Double Line, who's one of the smarter bond guys. And he's was one of those waving those semaphore flags that the Fed is out to lunch. They have no idea the damage that has already been baked into the cake, and we are going to have a recession. They're going to have to move aggressively and hope the bond market lets them get away with it, because we are seeing, and he characterized it as, the bottom 40% of the income ladder slash consumer economy is already in a depression. Forget about a recession.
Yeah, yeah, definitely. And I've been saying all along, this so-called gig economy where you got Airbnbs and Uber Eats and Uber car lifts and all these things. Um, those are a sign that the people are suffering. The only reason you take a side gig like that is you need the extra money. And the fact that these are services that are prominent everywhere is not actually a good sign for the overall economy. It means that the actual workers themselves are suffering and have to take multiple gigs in order to make ends meet. But I had my own little tour last weekend. We went down to Boston for the weekend. Bucket list number off. I got to see the Yankees and the Red Sox play in Fenway. I'd seen them play in Yankee Stadium. As a Red Sox fan, it was much more friendlier in Fenway than it was at Yankee Stadium. But when we were in Boston, we played a little tourist, like you. We're foodies. We like to eat out, and my observations were, first off, we were able to get reservations anywhere we wanted to, including some pretty prestigious restaurants, without a problem. When we got there, the restaurants themselves weren't full and weren't running at full capacity. We played tourist. We did a walking tour of the Freedom Trail, and the tour buses are passing us by, but they weren't full. They were like maybe a half, maybe two-thirds at best full. And this is the heart of tourism season in a very touristy kind of place. Um, I was looking at that and thinking to myself, going, "Yeah, this isn't a good sign of things to come."
Well, you're right, and I saw bits and pieces of that on my way up here, what little bit I could glean from it. And so far in my travels around here, I've seen much the same. You just get this general sense nobody's in a panic, nobody's jumping out of windows or anything like that. But people just realize that times are tough. They're going to get tougher. They're starting to hunker down a little bit, and they're going to eat out less. They're going to travel less. There were mixed signs even going into the summer's driving season. And again, even though the EIA officially has said that we've kept at record gasoline production, I think there too, it's only because you've got the story of the haves and the have-nots, and the people who were able to do it are still catching up for a couple of years worth of delayed travel. But I think that there are a lot more people who are having a hard time making ends meet that have already curtailed their demand and their travel, and that's going to broaden. It's going to go from 40% to 50% and 60 and maybe higher, to use Gunlock's example from the other day.
Yeah, and I got to start to think that some of the business travel is also going to start to lapse as we head into this, and again, that's you have to take a look at that effect as it's going down through everything as well.
Well, you will. I mean, and so after a really nice run that a lot of them had for a while, generally speaking, you're not going to want to be owning airline stocks or hotel stocks or all those different types of things. We figured out a couple or 3 years ago that we can get a lot done remotely via Zoom and whatever. That rather than travel, so there'll probably be a bit of a comeback there. Maybe Zoom and those type of stories would be worth a renewed look. I haven't looked at them in so long I couldn't even tell you what the valuations are of them. But yeah, I think that we're going to see more of that. And again, it's here's what people need to keep in mind as investors. We should probably segue and spend a couple minutes into how should you start to look at repositioning things in your portfolio. We're going into this recession and having this conversation at a period of time when there is still substantial liquidity in the markets. I mean, the broad money supply, notwithstanding the market's panicking over the Fed, waiting too long to cut it somewhat. The broad money supply has been rising for a number of months now. It hasn't been down. If you look at the financial conditions index on Wall Street, it's as lax as it was before the Fed started raising interest rates at all. So what we're going to see, I think, going forward, and I've mentioned this before once or twice when you and I have had this discussion, you're still going to have a world where you've got a lot of liquidity in markets. There's still a decent amount of credit available. And that's especially going to be the case as the yield curve steepens now, becoming more positive going forward. And I've said before, and I'll say it again, that 12, 18 months from now, you'll see a 3% federal funds rate, but a 5 or 6% 10-year treasury rate. What's that tell you? It tells you that inflation is staying chronically high. And because of that, because of burgeoning debt levels and the rest, the markets are going to continue to demand a premium for long-term credit. So if you're credit worthy, if you've got good fundamentals, good economics with your business, you'll still be able to borrow money. It's going to be at a higher rate than maybe you were used to 6 or 8 years ago, but it'll still be there. And this is going to cause a sifting. And frankly, if it's allowed to persist, and it may or may not be, that we still may be facing a point where it's so bad that the Fed slash the Treasury need to, do full-blown yield curve control. Not unprecedented. But that aside, you're going to have a world where, as an investor, you're going to have to actually be an investor again. You don't just throw money at anything because the Fed's got your back or because there's liquidity or whatnot. Do things make economic sense? Are the fundamentals there? Does the company you're looking at have pricing power, or the sector you're looking at have pricing power? And all of those things are going to mean something again. And that used to be a normal world.
Oh, you just took the wind out of my next question, which was, are we looking at a situation where we're pivoting back to normalcy again?
Oh, to a great extent. And I think and that is what is really starting to go off over the market's heads in a recent past. Didn't start this week with the Fed meeting and now the crummy numbers of the last 48 hours or so. It's been starting, some of the nosebleed Mag 7 stocks starting to get repriced downward. There was a point, I haven't kept track with the last couple or three trading days, but there was a point where Nvidia had given back over $1 trillion worth of market cap, because people were repricing that. For a while, started to jump back into small cap stocks, but then said, uh-oh, if we're going to recession, maybe we don't want to do that. And so, look, we have had such crazy gyrations in the last couple or 3 weeks that it's very easy to get whipsawed. Believe me, I've done it. You need a double or triple dose of Dramamine for this crap right now. So the smart thing to do is to just, not try and trade for the average investor these day-to-day swings. And, and as I said early on in our conversation, Mike, if we get into the next week or two and the Fed heads start coming out and now they're going to start telegraphing an aggressive start to a few rate cuts come September, then you could see everything bounce right back up again. But I think what will have proven to have changed now is that as difficult as it has been to trade corrections by shorting here and there in what has still been an upward trending market, it's now going to be a bit easier to short the market after bounces if we are going, as I believe, at long last, into the base case being a bear market.
So when we hit to the bear market, is it going to be like a sharp, hard drop into the bear, or is this going to be a long, dull toothache, into the bear?
I think it's going to be a slow, dull ache. What you have to ask yourself, what would cause the wheels to completely come off? Okay. It would be, for example, and we've seen this a couple of times just a few times actually in just the last generation and always at the end of the year when the markets think the Fed's going to be easier and they're not, despite the signs that they should. The markets throw a fit until the Fed runs up the white flag and capitulates. So, for sake of discussion, if we get to September and the markets have been clamoring for 50 basis points, the economic news has deteriorated, but the Fed only cuts 25. That'll give you a fast 5 to 10% drop off of wherever we are at the time, until the Fed, cries uncle. But aside from that, you've got to believe that commercial real estate and that debacle is going to accelerate in such a way that it causes systemic issues like we saw in 2008. Presently, whether that should or shouldn't happen, there are no signs of significance as I see it that that's going to hit everybody just boom. What handful of bank failures on the part of regional banks and other things that have happened in the last couple of years now. There's been overwhelming liquidity and whatnot in the markets to mute all of that. So it's not a big enough issue yet that it's going to cause a more widespread debacle in the financial markets and for the economy. Whether it still does remains to be seen. Or if you get just some other crazy political development out of left field, we've still got 3 months to the U.S. presidential election. God only knows what other surprises were going to be thrown between now and then. If the market gets shocked by something else or something unforeseen, that could cause a bigger, deceleration and things. But aside from that, the base case is still a slow, dull ache settling into the longer term reality of the great stagflation, and probably for a number of years, an economy that's going to perform below trend rather than above.
Well, that's probably a good place for us to sum things up, Chris. If people want to follow your musings as we move through the rest of the summer and into the crazy election season that's about to hit us, where would they do so?
Well, just go to nationalinvestor.com. If you're not already on my list, make sure you sign up. Follow me on social media. Those links are there as well at nationalinvestor.com. And realize that, the markets now have done such a 180 this week in their outlook for things. Doesn't mean that can't soften, and it probably will somewhat in the days immediately ahead. But again, I think we're making this transition into recession, but in a stagflationary one where there's still, tough to make ends meet for a lot of households. And you've got to be realistic about what that means for a lot of investments. I hate to be the bearer of bad news for people, myself among them, who still believe in a long-term secular bull market case for commodities. It's going to be interrupted a bit more rudely in the days ahead, if you're an investor there. So, gold is going to be the big winner. Gold itself in almost any scenario. The better gold stocks and the producers will somewhat keep up. Silver will get dragged along. I think natural gas is still an outlier. It's way too cheap for what the fundamentals of it are going forward. Crude oil is going to be at, blah. Although the pipelines are still a good place to keep your money for nice high yields. And aside from that, and uranium, I think, getting ready for numerous reasons, which is a story for another day, to have a new leg up in its bull market. Everything else is going to languish for a while. And so you're going to have to be cautious, keep a lot of power dry. And I think it's going to take getting into next year and the Fed being even more aggressive in trying to keep a recession from being worse than it will already. And preferably the icing on a cake being some wise policy choices that'll light a fire under commodities again. But I think we're going to have, a period of kind of a no man's land here, unfortunately, for them. And like I said when we started, our mutual friend Mike McGlone is very correct about that.
Yeah, the last question is it a real recession or a Beetlejuice recession where it's only a recession if we say it too many times?
No, I think we're going to have a real one. Things are going to bog down, and it's going to be a time where the average household and even the average small business does what they have simply to exist. It's going to be difficult for many to try and raise prices, but again, if you lower prices, you go out of business. So it's going to be tough. A lot of things are going to be squeezed. And again, I do throw in with the idea that we're going to see in some parts of the economy where it's non-durables, and again, those wants that we all have. No question will be disinflation, if not outright deflation for some of those prices. Already, just one quick example, look at the story about, the Chinese electric vehicles that they're damn near giving them away in different countries. That's caused the reaction for tariffs on a part of the Biden administration. The prime minister up your way is talking about doing the same thing. Europe a bit less so, but it's because you've already got such overcapacity and you got to move this stuff. You keep dropping the prices to move it. And so, China is going to be a wild card in all of this stuff. I'm going to be talking about that in the very near future. So make sure you're on my list for that, especially because they're going to have something to say about the net result in the world. Are we going to have a period of time of outright deflation before we go back to the higher prices and whatnot? So I don't see it, certainly not in this country, but they've already got it in China. I mean, you were talking about the implosion in bond yields of the last several days here in the US. China's 10-year paper is selling for half of what treasuries are. And that's because people in China are betting on a prolonged period of disinflation, if not deflation over there, which I agree with. I've said for a long time, as you know, that China has already started down the road of Japanification, and there's going to be all they can do to keep everything above water for years to come. The last thing you're going to see in China anytime soon is inflation.
Yeah, well, as Rick Rule says, we're the cleanest dirty shirt in the laundry. So interesting times as always. I look forward to circling back to you again in a couple of weeks, and we'll carry on these economic conversations.
Yep, absolutely. Take care, Mike.
The Prospector News podcast is for educational purposes only. The opinions expressed are those of the participants and are not to be taken as investment advice. Listeners need to do their own due diligence and seek advice of a licensed investment advisor.